But maybe we can pick things up from Friday very briefly, Danny, because I think that amongst the many stories that are driving the markets at the moment, the inflation one is the most recent. And there were some constructive signs on Friday. It's relevant because in the week ahead, we also get the PCE data, which is expected to show a slightly divergent message. Not by much, but we got a drop in core inflation in the CPI read to about 2.4%, almost a 5-year low. The core PCE number is expected to show a bit of a lift to 2.9%. Obviously, they're different measures. The Fed's chosen inflation gauge is the PCE data. But nevertheless, what we've seen in the last few sessions in particular is the markets are pricing in a possible chance, a coin toss will call it, of 3 rate cuts from the Fed this year. It didn't really last too long as far as the impact for equities is concerned, because there were some signs that maybe some of those service-driven supercore, as they call it, inflation might still be fairly sticky. So there was a bit of something for everyone in it. But nevertheless, there is this kind of persistent hope that really we'll get rate cuts again after an extended pause from the Fed, especially when Wash comes on board. And that's ultimately a good thing for stocks, maybe a bit of a headwind for the dollar.
Yeah, I think that's a good recap. As you said, markets currently pricing in the first cut to be somewhere between June and July, potentially another one by the time the autumn starts, about 50 basis points priced in there. And as you were saying, now a 50-50 chance we could get a third one, mostly on the back of that CPI data, as you said, coming in softer, specifically on the headline. Core was in line with expectations. And I think some of the market reaction that we've seen, initially we saw some risk appetite priced in. We saw stocks pushing towards the highs. We saw the dollar a little bit softer. That quickly reversed, and we've also seen some commentary from Fed officials since then, and it's kind of just giving this balanced view, right? That the data is very good. It's definitely in line with what's expected at this point, but there's still certain areas, certain pockets that have to be very closely watched, and that, of course, is services inflation. It continues to be quite high. One of the comments by Fed's Goolsbee is basically saying that, look, services inflation is still an area that we need to watch out for. The good thing is that at least we see that the impact on inflation of tariffs seems to now be behind us, which had been a concern for the past 18 months or so. So we seem to be over the height of the impact that tariffs could have on inflation. We just need to be careful about services inflation. It doesn't mean that we need to cut right now, but it definitely enables further cuts in the future, as long as that area is watch out for. And I guess you have to combine that with the jobs data that we saw prior to this, and that, of course, was still a pretty resilient economic landscape in the US, which has been the backbone of the kind of gradual easing, soft landing narrative that has been going for a while now.
Yeah, I think overall the data was on balance pretty good last week in the States. I mean, we also had the retail sales figures, which sort of suggested that maybe the household activity was a little bit sluggish in December, and there's sort of questions to what extent was there kind of a seasonal impact there because people were spending more around the discounting season in November. What impact did the government shutdown have on sentiment and household activity through that period, and weather as well? So that was a little bit of a dark spot, but the labour market looks pretty resilient in the States. Unemployment rate unexpectedly fell, like you noted, I think, just before, and that disinflation seems to be coming through. And I think that's kind of the really interesting question that we have going forward is, can we still see what's notionally a full labour market with ongoing disinflation? And the thing that everyone's talking about at the moment, we've spoken about it before, Danny, and in the other things that we've done in media and with Michael Kramer that we do our Twitter spaces with, this kind of mysterious productivity story, which may or may not have a lot to do or a little bit to do with artificial intelligence, and whether that will be something that continues to provide this kind of disinflationary impulse through the US economy. Because more or less, and I think this is one thing that needs to be noted, we're talking about a sort of still a tale of two Feds here, which is we've got the Powell Fed, which is probably not going to touch rates or policy conditions, all else being equal, really, for the rest of his tenure. But then we have the Wash Fed, which the first meeting is in June. As you noted before, Danny, I don't know if it's fully priced in yet. If it's not, it's very close to being fully priced in that Wash will take the reins and start cutting interest rates again. And the reason why he says that will be possible is because productivity is so strong, and that even if GDP runs with a 3, 4, 5% in front of it, potentially, we'll get an update on that this week too, The labour market remains relatively tight despite some of these supply side issues that we've got because of migration policy, maybe artificial intelligence as well, causing some disruptions in the labour market. That productivity growth will allow the economy to continue to grow and interest rates continue to be cut. It all sort of goes back to the point that we've made in the past that, maybe assuming a lot of this productivity growth is coming through because of the application of artificial intelligence, which is a very big and open question, that there is that big concentrated bet on AI delivering some payoffs, not from just an earnings point of view, but also from a macro point of view. But Danny, I can see that you've just got the NASDAQ up there because I assume that you're going to obviously talk about the price action, but there's also that very interesting, wouldn't want to preempt you at all, but that very interesting dynamic going on between tech stocks and the rest of the market now, and that rotation that seems to be taking place.
Yeah, a lot of the focus last week was, in fact, as you were saying, where are people placing their bets now in the US economy specifically? We know the tech sector has been very strong for several years now, been driving the majority of the market. And we have talked in the last few weeks about that sector rotation, people trying to find more potential value stocks, somewhere to shield their investments a little bit more, especially at a time where confidence has been a little bit shaky around bubble. There's been a lot of talk about, the possibility that the AI sector is in a bubble, that the productivity, as you said, it may not actually deliver as much as people have expected, that these returns, future returns are expected to be pretty high, still in the double digits for quarters to come, may not actually substantiate and may see, dragging down the general market, driven mostly by a meltdown in the tech sector. So you can see we have seen quite a bit of volatility. We've talked about this in the last few weeks. Of course, that metals meltdown also helping risk-off sentiment spread across the market as a lot of portfolios likely face some margin constraints. But if we see, we're kind of seeing the similar momentum here, as you can see, both in the S&P 500, which is more a broad-based market, and the NASDAQ. Also the Russell 2000, I'll bring it up because the Russell 2000 has been quite an interesting one recently as well. We've seen, I think it was one of the key outperformance last week. We saw definitely some upside there. So we are seeing some momentum that's maybe a little bit more broad-based. The breadth in the market seems to have potentially rebalanced a little bit, which had also been a key concern in 2025. The fact that the momentum was narrowing so much to a key 7, 8, 10 stocks in the market, and those were driving most of the gain. So we are starting to see that spread out a little bit more, not only in the US, we're also seeing some rotation outside of the US into other sectors of the economy, into other sectors of the world. Potentially Europe has been also a driver of a lot of momentum as well. You can see here with the DAX 40, we've seen a little bit more of a wobble recently, but towards the beginning of the year, we saw the DAX here on a very strong upward trend. So you can see the stock 600 as well. If you compare it to where the S&P 500 and the NASDAQ were trading at the same time, you'll see a lot more sideways consolidation. We saw this very clear uptrend here in European equity indices. So it's interesting to see where these moves are coming from. But as we were saying, we started off with the NASDAQ. We're trying to see some upside momentum today, as you can see, trying to regain that. As we said, it's a holiday in the US, so likely some thin liquidity around. Also, there's going to be a holiday throughout the rest of the week in Asian markets, specifically China. So something to watch out for will be potentially a little bit of jumpiness in the market. And of course, the metals market we know is very, very big over there.
I might see if I can just, as well, because I want to just share, as you were saying that, pull out a chart that's been doing the rounds that goes back to sort of the first point we're talking about there as well. In relation to tech stocks too in the Mag 7. I don't know if I can share my screen or if our handy producer on the back end can do that for me too. But as I'm talking, basically it's just about something that we discussed last week, specifically the issues around diminishing free cash flow and the capex numbers that we got out of the earnings results from 6 of the 7 Mag 7 stocks this earnings season, and also the kind of re-leveraging that we're seeing from, for example, Apple. I don't know if that story broke by the time that we had done this webinar last week, but tapping debt markets for 20 bill, including some fairly long duration securities. I don't know, Danny, you might be able to tell me very quickly how I can share my screen potentially.
You should be able to see it there at the bottom. You should have
yes, of
the
course.
icon.
Apologies. Let's see if I can get this. Pardon me. Window. go. Let's see if I can get that. Okie dokie. It's literally just a screenshot. Can you see that at the moment?
Yep.
Yeah, basically that's just a very quick impression on four of the Mag 7 as well as Oracle, and the free cash flow, the reduction in free cash flow forecast because of the CapEx plans that they've got going forward. A couple of points to make here, and one that I failed with initially too, because corporate finance isn't necessarily my strong point, but this is obviously a flow measure and not a stock measure. So this is to say how much of the free cash flow that they're generating quarter on quarter over time that they're effectively spending and drawing down on. So this isn't cash levels. So the stock measure, it's a flow of cash, or the money that's basically being used as the cash flow is generated to then subsequently spend on artificial intelligence, infrastructure and things of that nature. But it shows to you that one reason why a lot of these companies for a very long time were so sought out was their incredibly strong, obviously, balance sheets, cash levels, free cash flow in particular, and that's being worn down quite considerably. And it speaks to this kind of not bubble, but kind of slightly boom bust dynamic that's emerging at the moment, and why valuations are being compressed, which is to say that in this pursuit of all the Magnificent Seven companies to be the first and best player, at least in their space for artificial intelligence, or at least to dominate the AI complex, they're spending that extra dollar for a lower return, as you noted before. But effectively what that is essentially saying is that they're spending that extra dollar in revenue to capture that sort of diminished return going forward from artificial intelligence going forward. And that has the effect mechanically of more or less lowering valuations as investors look at what kind of what they're willing to pay for a lot of these companies. So the net impact of that, and I've got another chart here too that I could probably whip out, but it might be a little bit too cumbersome to do so. But we've got 6 of the Magnificent Seven companies more or less in negative territory now since the start of the year. I think Microsoft's down by about 17%. We've got Nvidia, who hasn't reported yet, that has to be said, is down by about 2%. But again, it comes down to this whole, I think, prisoner's dilemma that we're actually seeing within the tech companies, is that they've got all this cash that they're burning through. On the one hand, it's not fantastic for their valuations to be sort of spending that money because again it compresses those multiples, it reduces return on capital. But if they don't spend their money, they're going to get left behind in this AI arms race, and they're going to be caught behind, and then potentially face a level of obsolescence in the future. So it's a damned if you do, damned if you don't. And considering that there is still this significant drive to spend more and more money, and again, even re-lever a little bit from the perspective of Alphabet to be able to continue to scale up artificial intelligence as well, there is no sign that this is necessarily going to slow down. So it begs the question whether we're going to continue to see this kind of underperformance from tech names because of compressed multiples. And then, maybe we can expand it a little bit further too, because it dovetails into currencies a little bit too, when, the kind of perverse situation that the US dollar isn't really behaving according to fundamentals necessarily, depending on the sort of models that you look at. But, the case for cyclicality is very, very strong at the moment. The case for the US economy is very, very strong at the moment. As all you would have had to have done last week was listen to Pam Bondi for, her... I don't know, was it testimonial or whatever it was, but the Dow's above 50,000, the Russell's, obviously climbing as well. There is the sense that we might see that sort of continued downside in tech stocks from here, almost a sort of quasi 2000, 2001 scenario where expensive tech valuations deflate, but the overall market stays reasonably stable, or if not, some areas of the market continue to climb higher just because of that resilient economic backdrop.
Yeah, I think a lot of it's going to have to do with the narrative as well. As you mentioned, it's where I guess a lot of it depends on how you view the market and how you focus your mentality and your narrative towards it. As you mentioned, it's a bit of a damned if you do, damned if you don't. They want to spend the money, they want to be market leaders, they want to be in front, capitalizing on all of the positives that the AI sector is undoubtedly going to deliver. But at the same time, that is compressing their valuations. I think it has to do with how much investors want to focus on the now and how much they want to focus on the future. At the end of the day, we know that shares reflects, future earnings and expectations of future earnings. If you're looking at how valuations are likely to compress because of this increase in capex and the need to spend more money to stay in front of the game, if you focus on that right now, you're likely going to see some downside in the tech sector because, as you said, the numbers don't lie. If you're seeing compressed margins at the end of the day, especially when we come from a time where quarter after quarter, the numbers have been so strong and beating each other, it does have that kind of downside effect. However, if you look in the future and you expect that this increase in spending is going to deliver more profitability in the future, it's going to allow them to be market leaders, it's going to allow them to, to deliver better results, then you could potentially see a little bit of a floor under the tech sector. So again, I think, as you say, it's very hard to read how the market's going to react to this because it's a kind of double-edged sword where they need to spend the money to stay competitive, to stay in the game, but at the same time, spending the money does reduce the attractiveness of these stocks, especially at a time where people are just so focused on the good numbers and the amount of money that they have to spend. So it's going to be interesting to see how the market kind of reacts over the coming months on these kind of the change and the shift in these stories. I think
that's just before we run on, I think that's a really interesting point too, because I mean, one of the things that we've seen over the last week or so is the scares coming through from the developments with Claude and Anthropic, and then I'm not too au fait with some of the other models in particular that have been released, but the Insurify that's upset the sort of insurance landscape. There was another one that came through that upset some of the wealth managers. I think there was another model that was announced, and I can't remember, might have hit the pharma industry or something of that nature. But the whole point is that one of the really interesting dynamics at the moment is that the market doesn't necessarily know who the winners will be either, because increasingly it seems like a new model comes in to the market and seemingly completely disrupts and reshapes a particular business model. And those who were assumed to be sort of the winners in the past, or on track to be the winners in the past, very quickly get overtaken and raise that fear that they'll be the company that spends all of this money that ultimately goes to waste. And it's almost like, sort of now again with this, really big volatility that we saw last week. Again, I can't remember what the model was that dropped last week in particular that caused this volatility, because it was Anthropic and Claude a few weeks before that. But everyone seems to be looking around in the tech sector now very gun shy, sort of with this attitude that actually AI brings this awesome potential, but we don't know who's going to capture it. So rather than take the risk and placing our bets, we're going to sort of stick to the sidelines for now and let this kind of play out. And that sort of seems to be, one thing, even just from a narrative point of view, that is removing this bid from tech stocks. But I suspect that might be a little bit of a theme over the next few weeks that we'll probably be speaking about again, because, once more, it's every few days that something new drops and completely, turns, at least it turns the narrative again, flips everything on its head.
Yeah, I don't think this narrative is any longer constrained to just earnings season, which I think is something that had been happening up until now. We were talking about, every time earnings season came around, we were talking about investment in AI, investment in the tech sector, delivering. As you said, it's now a case of every update that we get for a disruptor in the market, you're likely going to then take a step back and view, okay, how does this impact the broader portfolio? How does this impact the broader market? And of course, are those Mag 7s going to continue to be leaders for much longer, or are we going to see increased competition come into the market, which is expected to happen very, very soon? Let's take a look at, we mentioned quickly the dollar earlier. This is of course, the FX window here. You can see the dollar actually quite an interesting setup last week. We saw that big pullback there on Monday, but really after that, we didn't manage to capitalize on a lot of momentum, a little bit of volatility on the Wednesday here, but pretty much unchanged, sideways consolidation here. Even on the Friday, as you can see there, we were trending higher throughout the morning, saw a little bit of a reversal on the back of that, ended pretty much flat on the session. Now, another big currency pair that we've been looking at, of course, is dollar yen. You can see here just how much volatility has come into the market, especially for a currency which we tend to see a lot more subtleness. You can see here a lot of it's having to do, of course, with the elections in Japan, with fiscal policy, with intervention concerns, and even threats from ministers in Japan. Considering the currency pair was reaching that all critical level between 158 and 160, which is where a lot of the talk up into intervention comes. It's going to be interesting to see. We have Japanese inflation this week, Kyle, I believe on Friday. Or
Yeah,
it's I think
normally
it's
drop it
like
on a Friday.
yeah, CPI is coming in on Friday. What are the views for that? I haven't actually looked at the data. Are we expecting to see some more upside pressure on inflation on prices and therefore likely to see a little bit more volatility here in dollar yen?
Let's just have a look. I just want to see where I can find that CPI data just to make sure that we're on the money. Oh, yeah, it's the national core CPI figure. So it's one of the, yeah, it's there's a few different releases. It says it's going to come in at about 2%, which is not a pretty constructive outcome. The situation in Japan is kind of interesting. One, we also had GDP data out today, which was vastly worse than expected, and weakened the yen once again. Kind of lent itself to this kind of somewhat scary scenario that even with elevated price pressures, that maybe we're seeing some sluggishness coming through the Japanese economy too. It sort of remains to be seen. It was a really, really significant downside surprise. But if you sort of zoom out and just talk about the policy mix at the moment, we did see that rally in the yen last week, mostly because there was a little bit of jawboning from the currency czar in Japan on the Monday after the Takaichi landslide, along with the fact that obviously the US dollar depreciated through the week as the markets increased the odds of 3 rate cuts in the next sort of 12 months or so. And we had that sell America trade coming back through again with those reports about the Chinese instructing financial institutions to reduce exposure to US treasuries. And there was even rumours as well during last week that weakened the dollar. It sort of played very heavily on the currency complex about Trump welching on the USMCA, which would be another really, really big shock to the currency market. But if, again, you look at the yen and you look at the fundamentals, we're effectively in this situation where Takaichi has this mandate to spend a lot of money. That money is going to be directed towards defence and also renationalising a lot of industry. Simultaneously, we have the BOJ, whether it be for muscle memory after years of worrying about deflation, whether because the separation between church and state, so to speak, when it comes to the BOJ and the government is a little bit closer than it would be in other parts of the world. So the BOJ sometimes doesn't like to step on the toes of the government if they've got, obviously policy objectives that they're trying to achieve. The other argument too is that they're, quite concerned about global financial markets and their impact on, financial stability, that they're not more hawkish, but nevertheless, you can see it sort of clear as day that with this wall of spending coming through from the government and a fairly accommodative, by the BOJ's own admission, set of policy settings, the yen is facing, fairly significant macro headwinds, which has only been ameliorated in the last week because of a weaker dollar. So, we've got this CPI figure, but, really the question is, will the reaction function of the BOJ change? Because it's not until the BOJ steps up to the plate and starts talking a lot more hawkishly about policy going forward. And it's still priced in that the BOJ will hike rates again this year, maybe twice, in fact, another 50 basis points. But it's not expected till the middle of the year. And we've still got inflation, with a 2 in front of it when it comes to their sort of official print. Again, national core CPI, it says it's going to come in at about 2%. It's more a bit of an indicator of, maybe the broader inflationary impulse in the country. If that comes in a little bit higher than expected, that's the kind of thing that, one would assume in a normal environment that would cause a appreciation in the currency, because one would assume that it would lead to a higher chance of a rate hike from the BOJ, but it may not necessarily be the case because, again, of the BOJ's incredible dovishness and reluctance to be too hawkish with policy.
I just want to bring it over now to the UK, because we actually have some data for the UK as well this week. We have employment data and then CPI data on Wednesday, I believe it is. Also an interesting setup. In terms of the political landscape right now in the UK is a little bit shaky. Labour continues to lead the government. However, there is a little bit of an internal struggle, especially when it comes to the government, the current government having not been able to deliver on a lot of its promises, especially when it comes to like cost of living, public services. So There is a little bit of an internal struggle right now in the UK. We have local elections in May this year, so there's going to be a lot of focus on the result of the local election. Potentially we get a little bit of instability after that, but nonetheless, just within that political landscape, which is putting a little bit of downside pressure on UK assets, we have some key data this week. As I said, we have the labour data tomorrow morning. Expected to see unemployment unchanged at 5.1%. Not the biggest reading. I think the most important one will be on Wednesday. We're going to get the CPI data for the UK. Expecting to see headline CPI drop to 3% in January. That's from 3.4% in December. I think it's interesting here to compare, where we are with the US and the UK, because for a time, UK and US inflation were pretty much tracking each other, remaining pretty elevated. It was hard to get them back towards that 2% figure. And now we see headline inflation in the US drop to 2.4%, in the UK still at 3%, if it comes in line with expectations. The previous reading was 3.4%. So almost a full percentage point as of now difference between the UK and the US. And if you compare the growth outlook, 0.1% growth in Q4 for the UK, whereas in the US we're still seeing quarterly growth above 2.5-3%. So very, very different scenarios and outlooks for these two economies, which I think is interesting to look at then the pair pound dollar, how it's been performing and how much it's been driven by the fundamentals in the US dollar, and kind of forgetting a little bit of the UK driver, the UK side of it, considering that the outlook is pretty bleak. As I said, that's expecting that inflation comes in line with expectations at 3% headline, core at 3.1% expected, with an economy that is marginally growing, 0.1% in Q4. This is very, very, very small growth when inflation still remains so high. So very, very tricky outlook for the UK. Still concerns about stagflation because the data doesn't lie. It's pointing towards that way. And if we're looking at the Bank of England, markets are now actually pricing in a higher chance that we do get a cut in the next meeting, which will be the 19th of March. Expected to see 65% now priced in that we get a 25 basis point cut. And by the summertime, expected to see potentially 2 rate cuts, which again, it's quite a contradiction to the US when we're only expecting to see the first rate cut between June and July. So very different outlooks right now in the UK and the US, especially considering where we were this time last year, where they seem to be going hand in hand, at least with regards to inflation and monetary policy. I think growth has been very different in both economies for the last few years. But in terms of inflation and monetary policy, they have been pretty close. That divergence is very, very obvious now. So I want to bring back the attention to cable, and you can see how the outlook here, the price action that we've seen in cable is pretty much the inverse to what we've seen in the dollar index here. So it's interesting to see how still a lot of the momentum in cable has been coming from that dollar weakness. You can see that time when we saw at the beginning of at the end of January, beginning of February, that very strong move towards 139, that was driven mostly because of that weakness in the US dollar. We've now retraced, hovering around 136.50, again, mostly on the back of that dollar stabilizing a little bit more, finding a little bit of support to push higher. So I think it's going to be quite interesting this week to see how that CPI data comes in line and how that affects expectations about rate cuts from the Bank of England, because it is becoming very, very tricky for the central bank to kind of focus on that dual mandate of stable employment and making sure that the economy is well supported, but also keeping inflation down, especially because the cost of living crisis in the UK has been quite bad for quite a while now.
Yes, and perhaps quite elegantly, it takes us to a perhaps cautionary tale of what happens when policymakers don't get policy settings right. You end up in a very unproductive economy when we're running into that kind of situation in Australia at the moment too, and it's why we're getting rate hikes over here. It's a very invidious situation for a central banker to be in. Danny, we've done 30 minutes. Yep. Late at night for me. We spoke about a lot. Shall we call it a day for another week?
Yeah, I think that's it. As you said, we've covered most of what's been happening, what to expect. So as always, thank you everyone for joining. This recording will be on YouTube on the live section, so you can always go back and watch it if you need to, and join us back next week here at the same time.
Sounds terrific. See you, Danny.
Bye guys.